Hey, old dogs. I just want to take a moment to welcome a new sponsor to the show, Smart Move. Smart Move is the best way I know to protect yourself from evictions and bad tenants. Smart Move has a special offer just for Old Dog listeners. Just go to tenantscreening.com, enter code OLDDOG25 at checkout, and you'll get 25% off your next screening. That's tenantscreening.com, enter OLDDOG25, and get 25% off your next screening.
This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we've got an exciting guest for today. His name is Josh Eitington. He is the co-founder of DXE Properties. Now, DXE is a value-oriented boutique real estate investment firm providing commercial acquisition and asset management services to their clients. Focused primarily in the Southeast, Josh brings a keen eye to each acquisition, identifying opportunities for growth. With a focus on optimizing property performance, he works closely with management to drive each business plan. Prior to DXE, Josh founded JAE Property Group. JAE was born with his first real estate investment, a 20-unit distressed property in Cincinnati, Ohio. Josh oversaw all major operations of the company and was instrumental in all phases of acquisition, asset management, and investor relations. Through JAE, Mr. Eitington and partners established a portfolio of multifamily investment properties clearly fitting into a well-defined investment strategy. Prior to JAE, Josh was one of two members on the acquisition team at URS Capital Partners, a real estate investment company located in Huntington, New York. Josh was an integral part of the company's growth from its infancy to the purchase of over $100 million worth of multifamily real estate. Josh is a Chamber of Commerce Award recipient, a graduate of the University of Albany, and resides in Long Island, New York. Well, Josh, welcome to the Old Dogs REI Network.
Thank you, Bill. It's good to be here. I appreciate the invite.
Oh, well, it's our pleasure. You know, for our listeners, I actually met Josh years back on a weekend multifamily sort of boot camp, and he was there. He's sort of part of that management team. It was great, seeing this young guy out there just getting in and crushing it in the multifamily area. So I'm excited to hear, what you've done since then. You've got your own company since that time, and sounds like you're just moving ahead like gangbusters here. So I'd love to just, kind of hear, I mean, we kind of give a little bit of your background, but, maybe you could just kind of, fill in the gaps there. Like, did you grow up in New York, and when
Sure.
when did you take an interest in real estate?
Definitely. So I always, even going back to call it college, I always was drawn to real estate. I think it just made fundamental sense. I think I started reading a way similar to the way a lot of people have started. Rich Dad Poor Dad was one of my first books. And it just was very, very practical, whether it was buying a two-family home and living in part of it and renting the other part, or owning multifamily in general. It made a lot of sense. So I always wanted to get into that field. I exited college and what may be one of the more difficult times to have gotten a job. So I was right in the middle of the recession, and really took whatever job I could get, which started me in the software space. I think I took maybe a little less than traditional role into real estate, but I worked with a mentor to get started. Then I transitioned from that mentor into the acquisition side with an investment firm, first as an analyst, and then as one of a couple acquisitions guys. And then ultimately left that company really to found and then co-found ultimately DXE, which is a real estate investment firm where we've acquired about 500 apartment units and about 25,000 square feet in retail space.
Wow, that's great. Yeah, maybe you can break down what percentage of your properties are multifamily?
The majority, I'd say, of maybe the 12 projects we've done, 10 have been multifamily.
Okay, great. Now, have you recently gotten into the other commercial areas, or was that something you did from the beginning?
About a year ago. Admittedly, it's not our focus. With our, like you mentioned in the intro, we are value oriented. Both of the deals that we did on the retail side were unique stories and deals, just off market, where we felt like we were buying some level of compelling value, stepping into it. Otherwise, we're not really pursuing any marketed retail deals. We don't really have an interest in competing with the general market on the retail side.
Sure. Now, when you went into DXE and founded the company, did you have properties you were bringing with you already in your portfolio, or did you start from scratch?
Yes, so it's a little unique. My first acquisition I did, like you mentioned, was a 20-unit deal back when I was 25, and I kept doing deals even while working full time. So there was a bit of a portfolio. DXE was founded when I pulled my partner out of his 9 to 5 job. He worked for Oxford Properties, which is he was a development arm of basically a Canadian pension fund. So he took what I consider a big leap, but he took a leap, and he ultimately bought into my existing assets. And then everything moving forward, we were collectively a part of.
Okay, so those assets were something that you went into. So you did have some cash flow, starting out.
Yes.
Okay,
yes.
And maybe just for our listeners, a lot of them are considering getting involved. Some are already involved in real estate investing. Talk to us about this 20 unit. So 25 years old. You're living in New York, but you found this property in Cleveland. Can you tell me a little bit about that?
Sure. So I was connected again through my mentor. Was connected to a property manager that was in Cincinnati, actually, that was active there and doing deals. And he was a good resource, not just on the management side, but also on the deal sourcing side. So this was back in 2000, I guess, end of 2011 into 2012. That property manager was working with a bank, working with someone, and that bank was dealing with a just distressed asset that they were in the process of taking back. But ultimately, my property manager was able to position me as the right buyer, and we negotiated a short sale. Actually, the bank relent on that property. And we were able to buy a property that was bought just a few years before at $550,000 for $175,000 a few years later.
Gee whiz. Do you have that property today? Have you sold it?
No, no. I think I learned a lot from that first deal.
Uh-huh.
I think one was that some action ultimately needs to be taken, and you're not going to know the answer to everything stepping into it. But it was definitely in a rougher neighborhood, rougher part of town.
Was it in East Cleveland by any chance?
No, it wasn't It's fair to say that because most of East Cleveland could get a little
a little rough,
a little dicier. Yeah, it was actually north. It's College Hill was the area where there's actually some good parts up there, but this was not necessarily. But most importantly, we bought it right. It never really consistently cash flowed for us like we anticipated that it may. So we ended up holding it for just about 2 years and sold it actually right around $500,000 a few years later.
That's great.
So, it was almost like a multifamily flip for us.
Mm-hmm.
And I just, more important than the benefit, and it was great for us and our investors, but it was my step in, and I learned an enormous amount in terms of what to do and what not to do.
Was it a sort of C minus class?
Yeah, I would call it C minus class.
Yeah. So yeah, that's the tough thing with those is getting through it, but the great thing is you do learn some real important lessons. So that's great. Were you looking primarily in certain regions now as you start to look for other properties? How are you kind of selecting where you were going to buy properties?
So the reason we focused on Cincinnati, it was on a few levels. One, we believed in the market, just diverse employment base. It was not necessarily reliant on one employer, good sized population, and higher cap rates than in other surrounding cities, markets, areas. And more important than that, we just had a strong team that we believed in. So we did the first deal and it was working well and wanted to continue to build there. We just felt that it could be more scalable, more efficient. So the next two acquisitions were also in the Cincinnati MSA, call it.
And what size properties you talk?
They were a 44-unit deal and then a 62-unit property.
Got it. And so you've had this target area in Cincinnati. You're focusing on that. Did you continue to buy all your other properties from that area, or were you looking? Are you starting to broaden out into other markets?
Broadened from there. The company that I worked for on the acquisition side, their focus was really on the Southeast. So I learned an enormous amount from them, considering they were doing it at a much larger scale than I was on the side at the time. So ultimately, my focus did shift, and our company's focus shifted to the Southeast, where as the market got more competitive and Midwest cap rates kept coming down, we're just big believers that if we're going to be paying a competitive cap rate, we want to be in a market that's showing more growth over the longer term. So it's really, call it, retargeted our focus to no more than 6 or 7 cities across the Southeast.
Now, you mentioned a company that you were working with that was in that area. Were they the ones that are bringing you the deals? And maybe you could elaborate on that relationship.
Oh, no, so I worked for them full time still. This was prior to to leaving them to found DXE.
Oh, so was this the JA?
This was URS.
Okay, that was kind of their focus, and they were finding better deals and things that look like they'd be a little bit more, long term and focused. You were getting investors behind you, syndicating these. Are you investing just your own money?
It's a combination. We always do make a point to invest our own money, though we also syndicate each deal. We've had cases where it's not a traditional syndication where there might be 10, 15, 20 investors. But there's been 2 projects where they've just been funded by 1 or maybe 2 individuals, and they take a little bit more of an active role in those acquisitions.
Gotcha. Now, are you a long-term hold? Are you looking at sort of a 3 to 5, 5 to 7, type hold, or what's your strategy there?
So it depends on the deal. Ultimately, we have a range of investors, and they're really dictating at least part of the strategy. Our typical time frame is 5 to 7 years. I'm personally a big believer if the asset's performing and doing well in a strong location, to just hold. I think the value compounds over time of just long-term ownership. But ultimately, while we're syndicating deals, people tend to want their money back in a reasonable time frame. So we, at least typically, have managed deals on a 5 to 7 year horizon.
And have you ever done sort of a cash out refi to pay back your investors as opposed to selling the property?
We have refinanced properties. However, and it would be a cash out to investors, but we definitely don't believe in paying off those investors with a refinance. It's just a return of capital, and they're still in it alongside us for the long term.
Got it. And what's your criteria for a property that your ideal property that you're looking for?
Sure. So right now, I'd say more than ever, just with where we think we may be in the cycle, we're very, very, very location sensitive. So I mentioned just a handful of cities. I mean, we're in Charleston, Charlotte. We will look at Atlanta, Greensboro, Tampa, Jacksonville, and really and Greenville, South Carolina. And really that's it. But almost as, if not more importantly, we're looking to be in a strong underlying location called a B area. Because we just think if or when a storm does come from a market perspective, being in a strong submarket is going to allow you to bounce back much quicker than in those C and C minuses.
Sure, I agree. And the age of the buildings, the properties and sort of, is it garden style?
Yes. So at this point, all garden style. I'd say 70s to the newest deal we have is 2003, but most of what we're looking at is 70s and 80s construction.
And what number of units are you targeting?
So we will target a range. Admittedly, our most recent deal we're doing is just a 30-unit deal in the uptown area of Charlotte, which is like walking distance to Bank of America Tower and where the Panthers play and all of those things. So we're more so price point sensitive, where we're focused on $5 to $20 million in acquisition size, and unit count. We're more flexible. I think it's a function of the right property manager to be able to manage the unit count properly.
Yeah, and that's, I think, one of the challenges sometimes with smaller units is you can't always justify having on-site management,
right,
unless you've got the numbers there, and so that can be a challenge. But if you've got other properties in that area, there's definitely a way you can leverage and maybe get that full-time person maybe that rotates around.
I couldn't agree more. I think if I'm just to give advice to a listener that might be, I started with that 20-unit deal without any other deals in a pretty rough location, and the scattered site management was really, really, really a challenge. Not being able to have a presence there on an ongoing basis, and a property manager that didn't necessarily have the scale to be able to run it especially efficiently. But if you do have the right manager that could share staff, or you could share across properties, it definitely can work.
Yeah, that's awesome. Well, in the experience that you have, and it's pretty extensive you're still a young guy here, but been through a lot. You've also worked a lot with these other companies that have major acquisitions going on. What would you say was sort of your first really big mistake that you learned the most from?
I would actually say it was the second deal I ever did, which was very shortly after the first. I think I was very, very excited. The second deal that I did was actually in east part of Cincinnati, where I think we bought it at a decent price, but it was 44 units, which is still very much at that in-between unit count where you really can't afford full-time staff to run through the property efficiently. And it was a location. It was a location issue that I think we thought we'd be able to manage it much more consistently than we did. and it just never really cash flowed with any consistency. So that also became a deal that we didn't hold too long. And then from then on, I said, all right, I've got to get out of this C- space, and really, really focused on location and not being afraid to pay up a little bit more to be in a stronger location.
So when you say location, so you're having difficulty getting good tenants in the building, or maintaining good tenants. Was that
exactly? Whether it be crime or just a lot of turnover or just tenant disputes, things that you're not necessarily going to deal with when your neighborhood is, a Publix and a Starbucks versus, maybe a Food Lion and
check cashing.
Worse. Exactly.
Place across the street. Right. Got it. Well, conversely, what would you say is sort of your biggest success to date?
I'll speak. I hate to keep coming back to location. I think one of my favorite projects I did earlier on was in Florida, actually, Panama City Beach area. An investment group bought a big portfolio, distressed, also coming out of the recession, and they wanted to flip out of this multifamily deal because it wasn't really their focus. And they were making over $1 million in less than a year, and I had a lot of reservations around just that fact alone. But what I kept coming back to was that it's well located. I could believe in it for that reason, and it makes sense on paper, and I can't necessarily get caught up on what they're making on the deal, especially at the time. And that was a property that was just bought right. We paid like $35,000 a unit, and it was worth over $50,000 a unit just 2 years later, without really putting much into it. And I think that part of that success was driven by having the right management and the right team. The prior group, they just weren't multifamily operators. So the leap of faith was that we would be able to operate it better than they could. And I was only able to make that leap because I had the right partner on the management side that was able to identify those issues and ultimately able to implement those improvements.
That's great. How did you find the company that had this group of properties here?
I've broken into a number of different cities without a presence on that side, and it's always a little bit of a challenge because you don't really know how that management company is going to be until you're in it. The best guidance I've gotten have come from referrals, just other owners or brokers that have done it and worked with them and have seen the reputation and taken it from A to Z with that management group. And then I'll interview and ask the same questions and all of those things. But, ultimately the referral has been the best guidance on that side for me.
Now, are you only getting off-market deals in your acquisitions?
So most of our deals have been off-market. We definitely do offer on marketed deals. I think at a bare minimum, it's helpful to keep a pulse on the market and also to continue to grow the relationship with the broker. Admittedly, there's not too many deals that we're winning when we're competing against 15 other groups. We're really just, ultimately we're trying to do 2, maybe 3 good deals a year. So we're being really, really selective. And when there is a good, strong off-market opportunity that we believe in, we're getting as aggressive as we can on terms to lock up that deal.
And those are coming primarily from brokers? Primarily,
yes.
Are you looking at properties that would be below market in the actual selling price?
Yes, I like to think so.
Okay.
I guess that remains to be seen.
Yeah, I know, right? Well, when you do your, at least your underwriting, you look at it as, this is something. I look at it as a sort of a value add deal. Is that you can go in there, if it's already a little bit below market and rents are low and you've got all the right stuff in place, it generally makes for a good. I mean, what are sort of your underwriting guidelines there?
Exactly. I mean, I don't want to say it's my favorite expression because I hope to be able to buy those deals one day, but sometimes some deals are just too pretty for us where I could tell you very quickly that there's not going to be enough meat on the bone for us, where we want to be buying a property where we feel confident that we could push rents $150, $200, through improvements, not just through hope. But we want to be able to create more quantifiable value that way than be reliant on just market appreciation or growth.
Right. Well, our audience are primarily folks, at least our target audience are those primarily that are approaching retirement or already in retirement. We have a lot of people, maybe even half, that are not necessarily in that camp, but the ones that, that we're focusing a lot of our at least our content to is, those that are 50 plus in age. And so they're approaching retirement. They're kind of concerned about, am I going to have what I need to have in retirement? Is there going to be a gap there? Am I going to be able to maintain the same lifestyle? Just a lot of questions. And we're here to present real estate investing as a means for people to be able to sort of fill that gap. And if they're going to be active investors, to actually go out there and, buy their own properties, that, they'll create a portfolio of properties that they can hand down as part of a legacy to their kids and so forth. So for that audience, what kind of advice would you give them about, again, they're starting later in life, so they don't quite have the same time frame that you do in terms of, being able to build and grow, but what kind of things would you recommend to those folks?
Yeah, I think on a few levels. One, I do think that in a lot of ways, the earlier the better, because that deal that you do, whether it's your own deal or it's an investment or in someone else's deal, that first year, the second year, there's always going to be some level of unknowns. And if you're stepping into a multifamily property and expecting to make 10% that first year, it's probably not going to happen. I think especially in this market today. However, if you could be a little bit patient, understanding that you are in retirement and ultimately you're doing it for the cash flow to come out of it, I would, encourage you to focus on more well-located deals and focus on what your normalized operations would be in the second or third year, because I think that's what you're ultimately chasing for, and you could hold it, much, much longer than that. I would just say don't necessarily get too excited by the 12 cap, because I just don't think that's the reality.
Well, I think it's great to hear that. I mean, just the honesty there, and I think it's smart too for folks to be able to set their sights on the right kind of return, because there's so many stories that people have. Oh man, I got 100% return the first year, and all these things, and
right.
And again, if we're the average Joe out there and you're trying to build up a portfolio, you're not going to always get what you're thinking, and especially, and I'm going to emphasize this a little bit because you talked about it, especially when you're buying those C- C properties that aren't. There could be some good C properties out there, that you can, if you buy it in a B area, especially, you can rehab, get it up to B status. That's great, but the reality is that they're just a lot more work, right? And it's buying, like you said, in the right area I think is key too, to reducing sort of the headaches. You might get a smaller return in some regards, but it's going to be more solid, long lasting, and have tenant retention, a lot of other things, right?
Yeah, especially at that stage in your life, that you're setting the stage for retirement, for some form of consistency. I don't necessarily think that that's the time to take the gamble. I think that most people, especially if you're not already in real estate, in your 50s, 60s, older than that, you're going to want to play it a little bit more safe, and it's a diversification method. It's tax efficient. So there's no reason to swing for the fences with that type of property, so to speak.
Yeah, good point. The company sounds pretty, like it's taken off. It's doing some neat things. What would you say differentiates you from other folks out there that are doing the same thing?
I think where we really, really try to differentiate ourselves, and and frankly, it's an old business, and there's only so many ways to differentiate. But we've talked about it a lot. I think a big portion comes on the renovation side, especially my partner's background, just being on the development side of the business. We really, really, really are particular on the improvements that we're making, really providing guidance down to like the door handle, making sure everything's done with consistency and to a level of completion that we're comfortable with and quality that we're comfortable with. And we really think that over time that's going to be a differentiator. Otherwise we're trying to be a little bit ahead of the curve on the technology side. We're doing that like downtown project that I mentioned, just the 30 units, and we're going to do some creative things in terms of offering unique amenities. We're actually going to every unit's going to come with a Amazon Echo, and you're going to be able to, from an app that we put together, be able to just speak to the Echo and submit a maintenance request that way, rather than have to call, be on hold, or log on your computer and go through the submission process that way. And just try to add a little unique amenities that may better retain the tenants. In that case, it's a millennial demographic that we're looking to retain. But do those small things to just try to differentiate ourselves.
That's neat. That's the first time I've heard that. So somebody in their room, in their apartment or what have you, could say, "Hey, Echo, I've got a clogged sink." And,
exactly.
I've never heard of that. That's awesome. Very, very smart, Josh. That's great. Great. Well, what do you see for the future of your company long term? What sort of your goals and vision for your company?
From a numbers perspective, we'd like to manage $100 million worth of real estate in the next 3 years. That's the goal, I think. Maybe as, if not more importantly, we really want to stay true to our investment methodology and belief, just really continuing to focus on location, buying, even if there's a possibility for a shorter term exit, buying with a longer term thought process. And just knowing that there could be some uneasiness on the horizon, and stress testing each and every deal, and really, really feeling good about those 2 to 3 acquisitions every year, knowing that they should be able to weather a storm because, their break-even occupancy is 78%, and even if we flatlined rents, we'd be fine for 3 years. So I think, from a goal perspective, if I can do that over the next few years with those 2 or 3 acquisitions a year, I think everything else will fall into place in terms of what we're looking for from an assets under management perspective.
Wow, that's great. That's great. Good to hear. Evicting a tenant can be painful and cost as much as $10,000 in court and legal fees. The best way to protect yourself from evictions and bad tenants is to screen your tenants. And the best way that I know to screen your tenants is SmartMove. SmartMove is part of TransUnion, a trusted consumer reporting agency with more than 4 decades of experience. They built an online screening service for independent landlords that delivers critical credit and background reports to you in minutes. It is a valuable tool to help you when you are trying to decide who to put into your rental property, and they can help you find your next great tenant. Only SmartMove has a credit score built specifically for rental screening called Resident Score, which can identify eviction risk 15% better than a traditional score. With the SmartMove report, you'll also get a criminal background check, eviction history report, as well as a full credit report. And only SmartMove has Income Insights, a report enabling you to analyze renter income to determine if further verification is needed. See why 9 out of 10 users recommend SmartMove, and more than 4 million landlords have used SmartMove to make better leasing decisions. SmartMove has a special offer just for Old Dog listeners. Go to tenantscreening.com, enter code OLDDOG25, and you'll get 25% off your next screening. That's tenantscreening.com. Use code OLDDOG25 at checkout for 25% off your next screening. SmartMove. Reduce your risk of non-payment and evictions. Our time is kind of zipping by here, and I wanted to move into what we call our wrap it up session. This is where I ask you a series of quick questions, and you can kind of give me as quick a response as you can, and it'll shares resources that you use or like, and for our listeners so that they can check these things out as well. So if you are ready, we can move into our wrap it up. Okay. Favorite real estate book?
So I like Powerhouse Principles. Jorge Perez wrote it.
Oh, great. Can you talk a little bit about that one?
Sure, yeah. He's a developer. He actually co-founded related companies, or at least was an early on partner, but started in Miami. Basically built his side of the business from nothing. And really, really great story. He shares a number of just his own successes, starting again from nothing and then building to what's an empire. He's an immigrant, and just really, I like that story. It gives a bunch of advice from both a business and also a technical perspective that I think is unique.
That's great. How about your favorite business book?
I don't know if this counts as business. It's I go back to Think and Grow Rich. That might be more personal development, but I think do like that one.
Yeah.
Okay. You'll accept that one? Okay.
Yeah. I get it a lot in that category. That's it's interesting. Yeah, it's a book that's impacted a lot of lives.
Mm-hmm.
How about most valuable website for success, of course, other than your own?
Especially if you're starting, and unfortunately when you're starting, it's a little bit of a scary world because there's a lot of people that may or may not have your best intentions in mind. But I think Bigger Pockets is a good free resource with just a lot of valuable tools that you could learn, read from, and just try to absorb.
Yeah, I gotta agree with you on that one. How about favorite app? Something on your phone that helps you out in your business or personal life.
Towards the beginning of the year, we started using Airtable. So Airtable is it's a SaaS tool. It's an app that really is sort of like a much more, I'll call it, sophisticated and prettier Excel, where we're really managing everything out of that Airtable, from our investor contacts to we store rent comp tables, and we could drag over attachments, and it's really a pretty powerful tool. So I think Airtable would be a good one from an organizational perspective to check out.
Is it Airtable or Aircable? I wasn't sure.
Airtable.
Table, T.
Yes.
Okay.
Yes.
Okay. Got it. Okay. I've never heard of that. That's great. It's got a new one there. How about your favorite quote?
I don't know who I don't know who said it. Money doesn't sleep is one I hear myself saying from time to time.
And then this one here, and this is always a fun one for real estate guys, but if you lost absolutely everything you have, every asset, everything, you are just down to $1,000 in cash in your hand, what would you do with that $1,000 to rebuild your real estate investing business?
I would take my best contacts out to lunch, and buy them lunch or dinner. But we'll see how far we'll see what gets
the $1,000 lasts. Yeah. In New York, you're not going to get a lot of. It's not going to last long on dinners, that's for sure.
But that's where I would start. I would start with the range of contacts that are closest to me, that whether it be from an investment perspective or just an advice perspective, and get them all in one room and try to open up those lines as well as possible. That's
great. Well, I think that's the heart of real estate, is really the relationships you have more than anything else. It's great. Well, I definitely want to give folks an opportunity to contact you, to find out more about you and what you do. What's sort of the best way for folks to do that?
The website would be best. So dxeproperties.com. and you can contact us through a form on there, or our email addresses are also available. And I'm happy to be a resource just in general from any perspective, whether it's someone that's been investing, thinking about investing, wants to invest. Always happy to jump on for a quick call.
And I just might add to it, that Josh, he's pretty modest here, but he has a wealth of information, having worked for some of the most successful investors and educators in multifamily. So I definitely think he is a wealth of information that if I'd take him up on that, you guys. So yeah, your phone will be ringing off the hook here. But anyway, man, it's been great having you on, Josh. And we have a tradition here, though, that all of our guests.
I know, I've been dreading it.
Yeah, it's one of those things that just kind of changes everything, at the end of the interview here. But it's fun, and I mean, you're in good company. Robert Kiyosaki's howled. Everybody's howled, right? So you can. Just go ahead and just give us your best old hound dog howl. Are you ready?
I'm ready.
All right. Hey, that's a good one. That's a good one.
All right. Thank you.
I love it. Well, Josh, it's been great having you join us. Thank you. I appreciate it.
Thanks again.
I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Now, please note, everything we talked about today with Josh is going to be in our show notes, and we have some of the most detailed show notes out there. And so there'll be everything he's talked about, some of the references he's talked about, and there'll be links to all the things that were referenced as well. So check that out on the interview with Josh Eitington. That is the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.